Good evening, everybody. Thank you very much for joining in. This side, Rahul Magan here as the Chief Executive Officer of Treasury Consulting LLP. And today we would be covering a video which is Japanese yen trading retracement. As you very well understand that Japanese yen is one of the hot currencies we would be having in 2017. And because they have a very good proximity with the Donald Trump. And today is a very great day because Donald Trump is turning out to be the 45th President of the United States of America. Right, I'm surprised that before November, nobody ever thought that Trump turn out to be the president, except few people like me, and everybody was expecting that Mrs. Clinton, would come out to be a president. But here, Donald Trump turning out to be president, and what action? And he's doing a lot of stuff in doing tweets and writing against China, the Silk Road, and all these. You know very well that. So this is a very good scene there's a very good scene which is happening for Japanese yen, because when the Trump took over, then the Japanese yen, I'm going to write not completely afterward, then the Japanese yen was roughly 102. When he took over from November till now, it went higher 118 and now it is trading at 114 flat, although this is 114.5. Now this 114 is a very good opportunity for the people to buy the Japanese yen. My personal expectation is that sitting today, the Japanese yen will go like this. It will reach to 120. From here, it would be a little selling point, and then we need to take a call whether it will come down or it will go up. There is a good consensus we have in the market that it will go to top, so it will go to 125 rather than reaching to 115. But how you are going to trade it, Japanese yen? Because the title which we are taking is a trading retracement, because there is a retracement which has happened. So it went to 118, it went to 114, it has touched 112 as well, and then it went to 113 and now 114. In my personal opinion, you should buy Japanese yen, you should buy dollars against Japanese yen, right? Now how you would be sure? So you would be buying dollars and selling yen. So today you are buying $1 at 114, which is today, having an expectation that after some times it will go to, say, 3 months, it will go to 125. But how are you going to do it? Suppose you are in an OTC market or you are in the exchange market. The best way to do is the Seagull importers. So what is Seagull? Seagull is nothing but you would have range forward, importer, and then you would have a one extra position which is sell call. So how you are going to create this? You are going to create sell call here, and here you have sell put, and here you have buy call. This is range forward. So net, there are a lot of people who will always refer this. There are a lot of people who will say a Seagull here is nothing but put plus call spread, which is put plus bull call spread. Now how to do that? Now I will write this again here. You would have sell call here, plus you would have buy call here, and you would have sell put here. You have only one position which you can take, which is this. If you are in the OTC market, you should ideally take this out of the money, which will create this as in the money, and this somebody who, because you are sell put, so somebody is buy put, somebody would already take this out of the money, so you would automatically be in the money. Take an example. If today, although I'm not calculating fully, but if today Japanese yen is trading 114, if I am at your place, I would be taking it at roughly 110 here. Here it is a sell call. It means somebody else is a buy call. I am a sell call. So if somebody else is a buy call, he would have taken out of the money roughly 112 something. And here it is a buy sell put. Sell put means I am sell put, so somebody is a buy put. If somebody is a buy put, he would have taken out of the money. Since he would have taken out of the money, you know, we have explained a lot of times in our YouTube channel that why we are going out of the money. Let me explain again in short. There are two reasons why we go out of the money. One reason why we go out of the money, because this will give you a good rate. Your downside is also protected, your upside is also protected. Another way of going out of the money, that in options you need to shell out premium. Since you go out of the money, you would be able to create a situation which technically is known as diplomatic premium, which is, I'm not saying that you are not paying any premium, you are paying any premium, but diplomatically speaking the premium would be very low. So if somebody is at sell put, it means if you are at sell put, somebody is at buy put. If somebody is at buy put, it means that he won't sell at 114. He would sell little lower, which is 112 or 113 something. So your scene would be like this, that you would have a range of 112 to 114. Believe me, if you do that, you would always win again. Let us check that. Assuming you have taken this for 1 year, and after 1 year, Japanese yen seriously turned out to be 125. Now case of buy call. Would you buy at 110 if market is at 125? You would surely buy. So you would have a gain of 15. Sell call. Would somebody else will buy from you if the market is at 125? Of course, he would buy from you. Here you would have a loss of minus 13. Since it is a call spread, so you would always be net. So here is a net plus 2. Sell put. You have a right. Sell put means somebody else is buy put. Here you have a right to sell at 113. Would he sell at 113 if the market is at 125? No. Then it is worthless. Since it is worthless, you will get the premium. So what would be the net gain? In buy call you paid diplomatic premium, which is 0. Here you receive premium plus P. Here you receive premium plus P. So net you would always be in a gain, which is 2 plus premium, which is 2 into 2 premium. This is the beauty how you can trade the Japanese yen today. And Treasury Consulting LLP would be putting a lot of orders in the exchange market and OTC market based upon that. So what you can do here, you can go to exchange and you can create a seagull. In the seagull you have one side range forward, so you would be buying dollars, you won't be selling dollars. So here you have one side range forward importer, and then you have one half sell call. Here you have a right, here you have an upper leg, so you will go out of the money. Here somebody else would have an upper leg, so he will go out of the money. For you it would be in the money. Here somebody else would have an upper hand, so he will go out of the money, you would be in the money. In both the cases you will receive the premium, and this is the net settlement how it is going to get happen. So this is purpose of the today's video, is to introduce you that the Japanese yen, how to trade the retracement. And if you have any questions, you're welcome to visit our website www.treasuryconsulting.in. My mobile number is 9899242978 and my Skype ID is Rahul5327. My email is rahul.magan@treasuryconsulting.in. Before winding up this video, we would like to update you that our online trainings academy is doing a lot of trainings now. We roughly have 16 different online courses which we are covering. Foreign exchange, basals, this, that and all. You are most welcome to have that courses, and these are very high quality 100% software and 100% practical courses. Plus Treasury Consulting LLP is coming up with its first newsletter of January 2017, because we planned that from January we would have newsletter. Hopefully you would have this newsletter maximum by 25th or 26th January. Probably if not, then you would have 1 or 2 days here and there. And the February 2017 magazine is roughly 8th or 9th February, which we are releasing. As earlier suggested, this time we would be covering more stress on derivative technologies, treasury technologies, Murex and others. The price of the subscription is very cheap, which is rupees 900 per year. We thank you very much and have a great time ahead.